Alright guys, welcome back. Jason Greystone here. Now this week's video, more of the same. We're going to be dedicating this video to answering some of the common questions that come through. Last week's video was on an entry technique called a lower low, lower close candle, or a higher high, higher close candle. Very popular, had 5,000 hits since we released it just a few days ago, so very popular. Lots of you found great value in that type of video, so we decided to do more. Lots and lots of questions in the live room, so we pick out a pool of the most common, and I'm going to dedicate a video each week to going a bit more in depth and answering those questions. So this week's video is all going to be based around profit taking. Now we all know that, or you may or may not know, that markets are in consolidation around 70 to 80% of the time. So you see the likes of myself and Akil trading consolidation patterns. Now whether you trade breakout patterns, flags, pennants, wedges, whatever it is, it's all some kind of consolidation pattern. We all have rules for taking profits, right? So it's not just the rules of entry, rules of engagement, it's the rules for profit taking as well that's just as important. And lots of you guys see us taking Gartleys and bats and CYPHERs. And the most common question that we get asked regarding profit taking is, without a doubt, if price action pushes beyond the decompletion of the pattern, why do you roll your profits down? You know, why do you roll with price action? Because surely that doesn't give you as much profit as you could potentially if you left the initial targets in, the conventional targets where they were. Why do you use the Fibonacci retracement tool to then move with price action and adjust your profit targets to suit? And there's pros and cons to each, right? So in this video I'm going to go over some examples and give you guys an understanding of why you might or might not want to consider this in your own trading. So grab a pen, grab a piece of paper, grab some coffee, sit back, enjoy the video, and I'll see you in a minute. Alright, so I'm going to give you a very clear example of a basic pattern formation, and I'm going to run through the pros and cons of rolling your profit targets with price action. Now what you see is, once a pattern formation has been identified, and you price action pushes down, we get our rules of engagement met, and the decompletion point is filled. We get filled this order and we're long. Okay, so we bring on our fib retracement tool to set targets, and conventionally lots of you guys set a target at the 382 retracement and the 618 retracement. Now the reason we do that is because we've tested, this is the way many of you have tested these strategies, and essentially you're looking for the 382 retracement of this move. Okay, so if price action pushes down, you would then roll the Fibonacci retracement down, because you're still looking for the 382 retracement of that move. Okay, now if you don't roll price action down and you leave your targets where they were conventionally, so as soon as you're filled, you place your targets at the 382, and we're going to talk about one target for now, just for simplicity. So in fact, let's delete this off so it makes it really clear. Okay, so you're looking for that 382 retracement, right? Now, if you was to leave your targets where they were conventionally and not adjust price action, and not adjust your targets with price action, so price action pushes down, and instead of rolling the fibs down and moving your target, you just leave your target where it was conventionally. What that means is although you're going to earn more profit out of the move, if you do get hit, if you do get filled, you're not going to win as many trades, right? So if you were to roll profit targets down with price action, and you guys see me do this all the time, what it means is you're going to be filled you're going to hit targets more often than not. And also it allows you to bring your stop loss to break even, and then you're in a risk-free trade for those of you who shoot for second targets or multiple targets, right? But essentially what we're saying here is if you move your profit targets down, roll the fibs down with price action, you're going to win more trades than you would if you didn't roll down with price action. Okay, so although you may earn more money by not rolling your profits down, you're not going to win as many trades. Now, I know this all boils down to the personality of the trader. Personally, I like to be right more than I'm wrong. I know many traders that have a 30 to 40% success rate or win rate, which means they'll happily sit through loss after loss after loss, knowing that out of 10 trades, say, they're going to be right 3 or 4 times, but they know that that's going to provide the return on investment that they want, that they're looking for. Okay, whereas most people, most human beings, I would say, like to be right more than they're wrong. That just suits my personality better. I like to be right more than I'm wrong. So it all boils down to your personality. But what I would say is when you're testing these strategies, take note of lots and lots of different profit target areas. So you could use the 382. You could bring on your fib retracement and say, right, when I test this strategy, what I'm going to do is I'm going to leave the profits conventionally. So I'm not going to roll down with price action, and I'm going to take the 382, the 618, even the 50%, even a retest of the A leg. And then you can note down if you was to roll targets with price action, then how profitable is it? If you take it at the 382, 50%, 618, retest of A, and those are all the different ideas that you want to pay attention to when you're noting down and you're collating the information and you're back testing, because this is essentially what's going to allow you to optimize your strategy to give you the best return on investment. And you might find that if you don't roll your profit targets with price action, you may win more money on that individual trade, but because you're not winning more trades than you would if you did roll with price action, then once you crunch the numbers at the end, you might find that there's not much in it. So it'll be up to you to decide whether you're comfortable taking more losses or you're happier taking more wins with less profit in each trade, because you might find that it's still the same return on investment, and that's the whole purpose of backtesting and optimizing your strategy. Okay, so the great thing about this is you can go and test all these different areas. You can test different styles of taking profits. And then at the end of it, when you've got all the results, you can say, well, hang on, this pair, although I rolled my profits with price action, it hit target 2s every single time. So I wonder if on this pair, if I just left targets where they were, would I still hit both targets? And because you've got all that information, because you've collated it in the first place, it's very easy to look back and say, yep, that one's very profitable. I'll trade that style on that pair and this style on that pair. So I really just wanted to give you an example of why you might and why you might not want to take profit targets at certain levels, and why you would want to roll with price action and adjust your targets to suit, because it's all based around your personality. You're either comfortable with being right more than you're wrong, okay, and taking a smaller win, or you're comfortable taking more losses than wins, but knowing that you're going to get a larger win. And that's really all it boils down to. But again, I'd say test all the different areas, fine-tune and optimize your strategy once you've got all that information, and then going forward you know exactly the best way to trade your strategy. So until the next video, hopefully you got some value in that, hopefully it made sense to you, and until next week, I'll see you in the live room.